CPI out this morning in line with consensus. And while the initial reaction is so funny because I'm watching tick for tick, and the market just, boom, collapsed. Futures, algorithms, those naughty algorithms. The chart below doesn't scream runaway inflation. I mean, look at this. Of course, when it comes to reading the economy, the devil is always in the details. So let's bring in Kevin Gordon, head of macro research and strategy at Schwab Center for Financial Research. Kevin, I mean, again, the chart itself, like, okay, 0.9 to 0.6 to 0.5 to -4, 0.4 to 0.1, doesn't sound like like runaway inflation.
Certainly not runaway inflation. I think it's, at a headline level, which is what you're showing here, it's important to see, the impact from energy, particularly in June. You had that massive decline. You actually still had a negative contribution from energy in July. It was just less so. Right. And then you also had a bounce back in some key parts, of course. So in terms of the sort of devil being in the details, of course, for the Fed and how they think about this and how they think about setting policy, you want to see more progress on the core front, which you admittedly did see. Right. The 3-month annualized change for core CPI as of July was down to 1.6%. You do have June in there, so you probably have to wait a couple of months to get that out of there in terms of the bias downwards. But still, if you kind of follow some of the comments that you get from some officials like John Williams, who has been out there saying if you get readings at 0.2% around that month over month, which is what we did get, that probably keeps you broadly on this disinflationary path and probably keeps the Fed out of hiking mode. So I think that's the important differential to keep in mind.
It is important because it feels like most of the Fed now, FOMC members are from Missouri. In other words, they made up their mind about a rate hike, and now you got to prove to them that they shouldn't.
Yeah, and I will say, I would put in the high conviction hike camp right now, still for now, just 3 people. I think it is Kashkari, it's Logan, it's Hammock. Whether you bring some others into that camp, whether it's, Governor Powell, Governor Waller, I do think that you would, number one, probably need to see a hotter PPI print tomorrow, because those are the components that map over into PCE, which is, of course, the Fed's preferred metric. But in addition to that, I still don't know if that would be enough to convince them. I think you need to wait for the August set of inflation data to see if there is, number one, an inflation problem, and number two, if you get a little bit of a give back and a bounce back from the weaker than expected and really surprisingly weak July payrolls report, which to us doesn't necessarily indicate that the labor market is in this state of outright weakness. There was enough in there from a seasonal
if you
work
look at government, for instance, right?
Yes.
If you back that back in, you got plus 30.
Yeah. And the World Cup effect, too.
Right.
So private payroll growth was still positive.
Right.
I don't think you saw any major disruption in trend for what's going on in terms of non-farm payroll growth and the average there, especially when you sort of back out the public sector.
So I'm bracing, in a good way, for the Jackson Hole comments.
Yes.
Now, of course, a few years ago when Powell gave those infamously hawkish comments right after I think it was the Michigan sentiment number, kind of swayed him back then. Yeah. It shook the markets big time. I feel like this is the platform for Walsh to go out there and really make his case, not only to his fellow members, but to the world, what he's trying to achieve. How important do you think it's going to be?
It is important. I mean, to the extent that we get more, I think, of a sense, and that markets get more of a sense of what his reaction function is, that was really sort of the key component that was missing in the last press conference was, despite all of this focus on, inflation being above target for so long and really wanting to combat the price pressures that the Fed is seeing, you didn't necessarily, at least the market didn't necessarily get a sense of how Chair Warsh at least was thinking about that. We can get a sense of how the rest of the committee does, and you can sort of do the bean counting over time. But I think in the speech in Jackson Hole, it's that combined with, are we going to get any more information on how he's thinking about inflation metrics going forward, what they want to track, some stuff early from the past.
Though, he's got a bunch of writing, right? Mm-hmm. He's somewhat prolific leading up to this, and I think he wanted to be because last time he lost the job to Powell, he wrote to the Senate. It's just, to me, I think he's saying, okay, he's hawkish, but he's not hawkish based on this. He's hawkish, but I think he sees inflation through a different lens. I don't think he believes inflation is that big of a deal right now, and that they're closer to the 2% target than his colleagues.
Well, I also think that, and it's not that he has explicitly talked about this, but you've also heard other members mention that in terms of labor, even though things have looked, at least from the way we see things have looked relatively stable in the labor market this year. You've seen, that nice bounce in average payroll creation on a rolling 3-month basis. Things have stabilized. Unemployment rate has rolled back over a bit. I still think that there are some members of the Fed, maybe a majority, that don't want to do too much to disrupt that labor recovery because it's still nascent, it's still earlier days.
Wages are a problem.
Yeah, and when you look, I mean, even with today, with the CPI report that came out today, if you took headline inflation, you took headline average hourly earnings, you were still slightly negative in year-over-year terms on a monthly basis. So you're not getting that wage-related inflation component, which I think that is probably the biggest benefit that the Fed has right now and sort of the bigger wind at their back in terms of staying on the sidelines when it comes to hiking because there's not much, if any, inflation pressure coming from.
So
labor.
before I let you go, I have to ask about your interpretation of the market, right? Mm-hmm. It's we had a big swath of days where the market was up, but there were more names down, and the market was down, and the breadth was better. You had more components that were higher. And we took a couple body blows so far this year, and we're holding up pretty good.
It is remarkable. You and I were chatting off air just about this sort of remarkable implosion in some of these momentum concentrated areas of the market. That theme having gone through such a significant correction, and in some cases, if you want to think about it in percentage terms, bear market in a short period of time, but yet the broader market, the S&P 500 as a proxy, doing relatively well. I think what has been most important, and I think for the broader structure of the equity market's resilience, has been the fact that despite going through all of those massive corrections under the surface, you still have the percentage of companies in the S&P 500 above their 200-day moving average that were moving up in that period. So you're close to 74%. That's pretty strong relative to history, not necessarily consistent with a correctional market, very much consistent with one that is rotational.
Great stuff. Kevin.
Good to see you.
Always appreciate you.
Thanks,
and
Charles.
your work, man.
Yeah.
Keep it up.